Joining me now is Michael Kantrowitz. He's the chief investment strategist at Piper Sandler. It's great to see you.
You as well.
Thanks for coming in. Did I characterize that correctly?
That's right.
And by the way, kudos. What do we call II now?
Xtel.
Thank you.
Yes.
Number one strategist for that call all year long, that there's something bigger taking place here. So tell us what that is.
Sure. You know, the market's been very focused, of course, where interest rates are going and what's been driving that. I would say in 22 and 23 was really more about inflation. And in recent years, we've started seeing the labor market soften. And I suggest that investors have a brief definition of history and have to look further back. And in periods specifically where inflation anxiety was very elevated, like today. And what we see taking place today and for the foreseeable future is softer employment, providing for lower rates. And in a market that's, we're seeing inverse correlations with equities and interest rates, that's been a positive.
Yep.
And that is what's been missing to get the market to broaden, get the economy to broaden, lower rates, to get manufacturing, transportation, and housing to get back to a better backdrop in 26 when we see that.
If I could put it as the eureka moment as I was reading your work, it occurred to me like this. I keep thinking about, softening employment data and falling interest rates and rate cuts as the end of a cycle, right? That's what was happening in 2008. The economy's softening, the Fed's behind the curve, they're trying to catch up, and that's a bearish sign. But then I read what you're talking about. You go back to inflationary episodes where that's the top concern for the market. And once you have employment softening and the Fed's cutting, then that means you're through the bear market. That actually is the beginning, possibly, of a rally and a broadening.
Yeah.
So you're pointing to that playbook as to people say, how can we possibly be in the early innings? Look at how strong the market's been.
Yeah.
Does that give you any concern, though? Like, we'd be building on a rally that's been so strong for the past few years.
Well, I think we have to compartmentalize the rally and where it's come from. We had a big bear market in 2022. PEs collapsed. Credit spreads widened. And it took basically 23, 24 into 2025 to recoup all of those losses. So we had AI earnings, which meant large caps and growth stocks did much better. But look at the Russell 2000. It's back to its highs. None of that is about earnings. It's all PE expansion. And it's because inflation's come way down. Prices are still high, but let's not conflate those definitions. Yes, the labor market softened, but the silver lining of that is that 2 years ago, interest rates peaked when unemployment started going up. We had mortgage rates of 8%, the 10-year over 5%. And now we're almost 200 basis points lower. And yes, it is a bit of a no pain, no gain situation.
And unfortunately, or fortunately, this is a weird thing about COVID, there was a massive hiring surge. Yeah. The fact that we're talking about the Great Resignation and people just phoning in their jobs, like, yeah, thank you that I've arrived. It's not like that anymore. We're unwinding that. Yeah. So Amazon cuts 14,000 jobs. Sounds scary, except that they doubled their workforce to 1.6 million during the pandemic. So the labor market reset, it seems to me the market is still perceiving this as there is some right sizing going on across corporate America still,
absolutely,
which shouldn't be confused with kind of where we are in the business cycle.
Yeah, not kind of margin pressure, pain-induced employment layoffs, which is also happening as well, that you've got AI-related layoffs, you've got normalization from COVID, and there is a cyclical component as well, certainly in smaller businesses. And I think that's going to persist into 2026. I want to be clear. I think the labor market remains very sluggish.
Right.
But that opens the door for rates to be to continue drift lower, the Fed to start, to continue cutting, and seeing a broader improvement in housing, manufacturing, transportation. People have gotten so bearish on these parts of the market.
And look at the ISM again yesterday.
And it's still weak, but it's been kind of hanging around. And all of our forward-looking indicators suggest that finally in 2026 we'll start to see that get back into expansion. Up until 3 months ago, we were not seeing those signals.
So what are those signals, by the way? It's fascinating.
So it's changes in interest rates, changes in oil prices, changes in money supply growth, changes in the yield curve. And I'm not even including the fiscal policy kicker that we're going to get in 2026.
Because you can do the expensing immediately of depreciation or whatever it is that the people say it could be half a point of GDP. We're going to see in the first half.
All of that's gravy, but it's really as simple as 2 years ago we saw interest rates peak after rising into 2023, and they stabilized. The 10-year kind of bounced around for about 2 years and is now near the low end of it. The Fed's been cutting for over a year. It's those changes in rates which help to normalize the economy. And people are getting too stuck, I believe, in the bearishness and kind of thinking that this will never change. And that's where things typically do start.
No, I appreciate